Identifying trends and trading ranges is one of the hardest tasks in technical analysis. It is easy to find them in the middle of a chart, but the closer you get to the right edge, the harder it gets. Trends and trading ranges clearly stand out on old charts. Experts show those charts at seminars and make it seem easy to catch trends. Trouble is, your broker does not allow you to trade in the middle of the chart. He says you must make your trading decisions at the hard right edge of the chart. The past is fixed and easy to analyze. The future is fluid and uncertain. By the time you identify a trend, a good chunk of it is gone. Nobody rings a bell when a trend dissolves into a trading range. By the time you recognize that change, you will lose some money trying to trade as if the market was still trending. Many chart patterns and indicator signals contradict one another at the right edge of the chart. You have to base your decisions on probabilities in an atmosphere of uncertainty. Most people cannot accept uncertainty. They have a strong emotional need to be right. They hang on to losing positions, waiting for the market to turn and make them whole. Trying to be right in the market is very expensive. Professional traders get out of losing trades fast. When the market deviates from your analysis, you have to cut losses without fuss or emotions. When you identify an uptrend and decide to buy, you have to decide whether to buy immediately or wait for a dip. If you buy fast, you get in gear with the trend, but your stops are likely to be farther away and you risk more. If you wait for a dip, you will risk less but will have 4 groups of competitors. Longs who want to add to their positions, shorts who want to get out even, traders who never bought, and traders who sold too early but are eager to buy. The waiting area for a pullback is very crowded. Markets are not known for their charity, and a deep pullback may well signal the beginning of a reversal. This reasoning also applies to downtrends. Waiting for pullbacks while a trend is gathering steam is an amateur's game. If the market is in a trading range and you are waiting for a breakout, you have to decide whether to buy in anticipation of a breakout, during a breakout, or on a pullback after a valid breakout. If you trade multiple positions, you can buy a third in anticipation, a third on a breakout, and a third on a pullback. Whatever method you use, there is one money management rule that will keep you out of the riskiest trades. The distance from the entry point to the level of a protective stop should never be more than 2% of your account equity. No matter how attractive a trade is, pass it up if it requires a wider stop. Money management tactics are different in trends and trading ranges. It pays to put on a smaller position in a trend, but use a wider stop. Then you will be less likely to get shaken out by reactions while you keep risk under control. You may put on a bigger position in a trading range, but use a tighter stop. Finding good entry points is extremely important in trading ranges. You have to be very precise because the profit potential is so limited. A trend is more forgiving of a sloppy entry as long as you trade in the direction of the trend. Old traders chuckle. Do not confuse brains with a bull market. When you cannot tell whether the market is in a trend or in a trading range, remember that professionals give the benefit of the doubt to trading ranges. If you are not sure, stand aside. Professionals love trading ranges because they can slide in and out of positions with little risk of being impaled on a trend. Since they pay low or no commissions and suffer little slippage, it is profitable for them to trade in gently fluctuating markets. Those of us who trade away from the floor are better off trying to catch trends. You can trade less frequently during trends, and your account suffers less from commissions and slippage. Most traders ignore the fact that markets usually are both in a trend and in a trading range at the same time. They pick one time frame such as daily or hourly and look for trades on daily charts. With their attention fixed on daily or hourly charts, trends from other time frames such as weekly or 10-minute trends keep sneaking up on them and wreaking havoc with their plans. Markets exist in several time frames simultaneously. They exist on a 10-minute chart, an hourly chart, a daily chart, a weekly chart, and any other chart. The market may look like a buy on a daily chart but a sell on a weekly chart and vice versa. The signals in different time frames of the same market often contradict one another. Which of them will you follow? When you are in doubt about a trend, step back and examine the charts at a time frame that is larger than the one you are trying to trade. This search for a greater perspective is one of the key principles of the triple screen trading system. A losing trader often thinks he would be better off if he had a real-time quote machine on his desk. One of the universal fantasies of losers is that they would be winners if they could get their data faster and focused on a shorter time frame. But they lose money even faster with a quote system. When that happens, some losers say they would be better off trading right on the exchange floor without any delay for data transmission. But more than half of floor traders wash out in their first year. Being in the middle of the action does not do losers any good. The conflicting signals in different time frames of the same market are one of the great puzzles in market analysis. What looks like a trend on a daily chart may show up as a blip on a flat weekly chart. What looks like a flat trading range on a daily chart shows rich uptrends and downtrends on an hourly chart, and so on. When professionals are in doubt, they look at the big picture, but amateurs focus on the short-term charts.